Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over some 1998 oil price projections that are just dead nuts on. I mean, it's funny because I'm hearing all these projections for oil. I'm hearing these projections about how, I should say, if history were to repeat itself, I put on Twitter that oil could potentially go into the $200 or $300 per ounce, depending on where gold goes. Gold's not going to stay at $1,800 an ounce. It's going to go far higher. There's too much money in the system. It's going to force, no matter how much you think this is controlled, it's going to force it higher. We're gonna hit shortages of this stuff. It, in my opinion, it's going to go a lot higher, especially if interest rates firm up and start to break out of this long-term downtrend. So at the beginning of commodity bull markets, everyone always undershoots the price projection of where these things could potentially go. Unless you're on Finding Value Finance channel, where we are well educated in ratios and we know what the tops of these ratios can be. And what the tops are of these ratios is the psychological threshold of what people are willing to pay for these commodities in relationship to the money supply, in relationship to other items in this world. So if gold's at $2,000, to make the math easy, if it goes below a 1 to 10 ratio, that's $200 oil, which means that it could easily be $200 to $250 a barrel. A lot of people will say, well, what does demand look like? Doesn't matter. That is what the demand supply balance looks like in a world awash in dollars. What happens when the dollars get scared out of bonds and stocks? Where are they going to go? Oh, wait, they're going to go to an inflation investment, inflation sensitive investment, which is positive, which goes up and highly correlated with inflation. So when money starts piling into oil, where do you think oil is going to go? You think it's going to go up, or do you think it's going to go down? All of that money that was created through QE and all these stimulus packages went into stocks and bonds. When this unwinds, where do you think this unwinding is going to go? When interest rates go up. It's going to go into commodities, Mr. Finding Value Finance. Yes, it's going to go into commodities. What do you think that's going to do to price? Those markets are vastly bigger than the markets that we're in. It's going to blow them up. What do you think the CPI is going to do when this money rotates over into the commodity sector? It's going to blow up the CPI. You're going to see massive inflation everywhere. I don't know how they're going to handle this. No idea. But you know what? Doesn't matter. What matters is that I'm to the party by myself, like I am, and like a lot of the people on this channel are. We got into our positions in the 2020s, 2021, and now 2022. We're still early. And I just wanted to go over some price projections here. I wanted to go over some of that. Here's some price projections in 1998. In 1998 was the beginning of the commodity bull market. If I were to show you what this looks like, and let me look real quick here, just to show you where we were in that type of scenario here. So here it is. I'm going to zoom in here. This is 1998. 98, 99 was the bottom. 99 is right here. 98 was just before it. So I'm taking the projections in 98, which is just before a large commodity bull market came. And in this ratio, this is the commodity to S&P 500 ratio. This was throwing a buy signal in 98 and 99. And we had it in the early 1970s, and we have it today in 2020, 2021, and 2022. This is going to start to vastly move higher. We bought kind of in the lull before the big move on the Finding Value Finance channel. So this is what the projections were in this green circle down here. This is the EIA, world oil demand, and they were off a little bit. This is 2020. We've got historical, forecasted, and extrapolated. We are in 1998 where this line is here. looking forward at the forecast and extrapolated forecast. And these were the projections in 1998. They had a little bit, demand being a little bit higher. We're probably more at like 100, a little over 100 barrels, with the slowdown that some of these countries are doing with the oil demand. This is world oil price, the EIA. We were at $12 a barrel, and they were projecting in 2020 a vast, huge increase of $23 a barrel. Way to go. And then the APERC world oil price, they were thinking, maybe $17 a barrel all the way out in 2020. So their projections were obviously vastly off. Why were they off? Well, they were off because they didn't account for inflation. They didn't account for the inflation that is out in this world. And you know what? Same thing's happening today with all these other projections. They look at supply and demand, supply and demand. Well, you know what? You got to take inflation into account. It's going to push the entire cost curves higher, irrespective of technology. We are printing more money. We're going to create more money than technology can increase its efficiency. So the price of oil is going to go vastly higher. It's done it every single time in history. Technology has always gotten better. We are easily, the technology in 1998 was vastly better than the technology in the 1970s. But here we are with oil prices vastly higher. When people try to, technology does not fix this problem. It's a problem of dollars chasing assets. Just because dollars went into stocks and bonds and are going to rotate back into commodities, nothing's going to change that technology-wise. To have the argument that technology is going to change it is a huge misunderstanding of how this entire thing works. It's a huge misunderstanding of how markets work. Markets work, and it's just how money flows back and forth. The catalyst for that flowing is interest rates. And interest rates move based off of the real estate market, which is the supply and demand of loans. More demand for loans against new assets, which puts money into the system. And all that money coming into the system is inflationary. And that inflation has an impact on bonds. And bondholders selling increases interest rates. That is the entire cycle. That is all you need to know about investing for the most part. And everything else is just refining it around it. Now, I'm going to pull another chart that I have up. What this is the annual U.S. housing starts from 1890 to 2015. This is more Thesis of the channel. 1920s crash. If you were to look at this and you were to say, well, the average is about here. And whenever you go above the average, it goes into a leveraging up phase, a credit expansion phase. And I'm going to say the average is somewhere in this range in here, looking at history. So what happened was we had a huge boom in housing in the 1920s. And then it went below this average at about 1928, 1929. That's when the crash happened in the 1929 crash. It was a real estate driven, deleveraging, deflationary crash from real estate. They had all these easy loans, easy everything back here, and it burst. Now, I've heard some people talk about fiscal spending. I'm not sure how much fiscal spending there. I'm sure there was fiscal spending in the 1940s. But one thing I wanted to highlight here is that in the 1940s, we had a massive real estate boom that lasted till in early 50s, mid to early 50s. This was the reason that we had increasing interest rate environment. Was right here, increasing interest rate. And we boomed all the way out till about 1980. If you look at the new housing starts level was vastly higher than anything it was before the 1940s. This was an entire big boom, which was inflationary the entire time because of the loaning into the system. More and more loans, a leveraging up of credit in the entire system. And today, where we are today, is an increasing expansion phase of real estate. I'll pull it up and show you what this looks like from the newer thing here. I'm going to look at the housing starts. So looking at the housing starts here, which is right here. This is the average going back to 1960. And if we were to kind of gain our bearings here, 1960 is right in here. So this whole level, this was the average down here, and then the average went way up here to just under 1.5 million or so. That average is the inflation into the system, so to speak, from bank lending. And we are coming on up here. If I were to show you, we're coming on up, and we're above the average again, and we're into an expansionary phase. We have a housing shortage. So all these people that are talking about housing being in a bubble, they're wrong. They're just wrong. They're flat out wrong, in my opinion. And it's getting me a little bit mad because I'm seeing it everywhere. And it's like, guys, enough. You've been, how wrong are you guys going to be? We have a shortage in homes. It's 5.2 million homes that we are short. Inventory is eaten up. Rent prices are rocketing higher. If all of this is happening, how are we in this gigantic bubble? I mean, basically to say that the housing prices are in a bubble is to say that we didn't print any money. This money's got to go somewhere. It's going to go into real estate. It's going to drive these prices higher. Now, is real estate going to go up every single day, every single month? No, it's not. It's seasonal. And it's going to take time for this to all turn around. And in my opinion, we're probably going to be in a huge boom phase, an expansionary phase of real estate for some period of time. And it's probably going to last till 2025 to 2029, somewhere in that range. And I can't tell you exactly. We have to monitor it, watch it, and see what happens. And we'll look at it, and if inventories start to go way up, and it has to go above 6 months of inventory. Once it goes above 6 months of inventory, then I'll start listening. I'll say, okay, we could potentially have a housing market that pulls back some. Not necessarily a crash. These people calling for crashes, I don't know what it is with all these people calling for crashes. Do they not know? I mean, I'm starting to get a little bit frustrated with it. I'm reading a lot of crash stuff, and it's like, what data do you have? Is inventory just rocketing higher? And I don't want to hear a percent. I don't want to hear 40%, because if you're at all-time lows, a 40% increase is nothing. We need to go up 1,000% increase in inventory to get to a level where we could potentially go down, or whatever percent increase. It's far greater than 40%. Because if you're at a 1 month inventory and you have to go to 6 months, that's a 6x that you have to do. You have to 6x going up. It's a 700% increase to get to a possibility of going down. It's going to take a lot of time. And where's this inventory going to come? Are you just swapping the people's? If you don't, you have to build your way out of this, and it's going to have to be expansionary. It's going to have to be new loans. It's going to be inflationary. It's the way the system works, and that's the way the cycle rotates, at least in my opinion and what I'm seeing. So I have seen a lot of crash calls, and I'm just getting a little bit frustrated reading it. More news also is looks like Kazakhstan is having some problems. And it's obviously going to manifest itself in probably higher energy prices and higher prices all over the world, because they do produce oil, they do produce uranium, they do produce all these things. I don't know what the necessary outcomes are going to be, but we're positioned already in the cheap stuff. So if this stuff blows up because of whatever it is, we're in it. We're in it to win it. So I'm not changing anything of my viewpoints on any of this stuff here. And if something happens there where it really delays the production of oil and the production of uranium, well, we're in those sectors. You should already be in them, and you should be sitting in it. That's why we don't trade in and out of these things. We are in it for the long run. And I think they produce something like 1.5 or 1.8 million barrels of oil per day. And it's like something on the lines of 40% of uranium production. That would be a huge hit to both of those sectors if a lot of that production were to come offline for those two energy sources. So I wanted to touch on the housing starts, wanted to touch on projections that were of previous 1998 projections, which were completely wrong. So when you start to hear these people talk about projections, they talk about all these things. They're most likely going to be far too conservative. They're using yesterday's paradigm, projecting yesterday's paradigm forward. We are not in yesterday's paradigm. We are in a new paradigm. We are in an inflationary, we're in an inflationary cycle that has started in 2020. The bottom in that cycle was when we had a capitulation bottom in interest rates in 2020 from the C-19 medical event. It's inflationary on forward here. So you got to throw that old paradigm, crinkle it up, throw it in the garbage. And I've talked about this before on the channel. Inflation's going forward. And the way that these investments, I think, are going to play out is going to be very energy driven. The majority of my outlook is based off of the energy aspect because that's the most inflation sensitive. And I think precious metals are going to do incredibly well going forward in this new environment. When will they go and explode higher? That is anyone's call. I'm not in the game of getting the exact precise moment. No one can do it. It's about positioning, position sizing, and knowing the market conditions where these things flourish under. We are in those market conditions where energy flourishes, where precious metals flourish, and where some of these base metals are going to go berserk, like copper and tin and some of these other base metals. And there's other investments too, guys. I understand it. Lithium, graphite, they're all good. I'm on board. Don't get me wrong. And agricultural products are good. Fertilizer's good. I'm saying in general, the commodity sectors are going to blow up because of inflation. It is driven by inflation. It's driven by money flows and interest rates. So the way that you want to watch this is through interest rates and watching how the dollar interacts. The dollar should go down, interest rates should go up, and that money's going to just flood over. It's going to be the great flood of 2022 of money into commodities. And this is the beginning, and hopefully you guys are on the right side. Hopefully you've got your investment set. Hopefully you've got a strategy, position sizing, everything that we've learned on the channel. Implement it, use it. And if you don't know what I'm talking about, you can look in the playlists that I created and start binge watching all of those clips. Because what it's doing is going to get you up to speed on where you should be investment-wise and mindset and paradigm and developing as an investor. So if you guys like this content, give me a thumbs up, subscribe to the channel if you haven't already, and thank you for listening. This is Finding Value.